We're here with Constance Hunter from KPMG here in sunny, beautiful Maine this morning. Constance, as far as the economy is concerned, I know you've been involved with a big survey, not only as far as National Association of Business Economics is concerned, but also people here.
Yep.
What have you learned?
Well, it was a survey where there was a lot of consensus, right? Not that many people forecasting a recession next year. We asked when people were expecting a recession, and the ranges were from the middle of 2019 into the middle of 2020, about what people would expect. I would say the question that I thought was most surprising and had a bigger dispersion was we asked people how trade is going to impact, how the current trade is going to impact their GDP forecast. And the biggest negative was negative 150 basis points. So it definitely skewed to the left, to the negative side. The majority of people, of course, said zero, but when you asked them, they didn't really think it was zero. They just didn't know how to actually scientifically account for it in their models. And I think that this is one of those situations where we're sort of underpolling the impact. There were one or two that actually thought it would have a positive impact on GDP. But I thought that was one of our more interesting special questions that we had this year.
Well, how do you view it through your lens and what you're doing?
Yeah, well, I would agree it's not so easy to quantify, aside from just looking at the goods that are tariffed, figuring out the increased costs and estimating what that increased cost is going to do within the economy. One of the things that we've done is we've shocked our model, which is really the only way you can do this. You take an exogenous variable and you shock it. And so we shocked the volatility index higher, because what we noticed was on days where the trade rhetoric was worse, what happened was equities sold off. You saw the VIX elevate. And so we figured that if there were a very pronounced or increased amount of animosity in the trade arena, excuse me, too much singing last night, that we would see an increased VIX. And when we put that into our model, that increased VIX translates into higher BAA bond spreads, which of course is higher financing costs. It translates into less investment. It translates into less GDP.
History shows us that most expansions just don't die of natural causes. There's some sort of shock, whether it's an oil shock or a policy mistake. Did the survey results get into any of those kinds of issues? And are you concerned, is trade potentially that shock?
Trade is potentially that shock, for sure. I guess the way I would see that panning out is not just the reduction in GDP from higher financing costs, but the fact, actually, I take that back. I think trade is not necessarily the shock. I think the shock is the Bipartisan Budget Act of 2018 that pumped $300 billion into our GDP over the next 2 years. And what we did once the Q2 GDP came out is we analyzed the first half growth on various metrics versus all of 2017. And we found some interesting things. So we found investment increased. So it went from about 4.5%, I think, to 9.3%. So big increase from all of 2017 to first half annualized. Exports went up significantly. We think that's going to fade. But the other thing that went up really significantly was that government spending was up 0.3% in 2017, or 0.7% in 2017. It was up 3% in the first half of 2018. It's given a big boost. And the danger there is that causes higher inflation, that higher inflation causes the Fed to raise rates at a faster pace, and that along with trade will probably, or could, I shouldn't say will probably, could be a possible trigger. We're not seeing really capacity shortages yet, right? Aside from the oil and gas industry, if you take capacity utilization and you take out mining, not seeing a lot of shortages. Credit looks pretty good. So the credit profile of households looks pretty good. So I think it is going to probably be an external shock.
Just one more question. The administration, of course, loves the second quarter GDP number. Are we going to get another one like that in the third quarter?
Well, I don't think we're going to get as much of a contribution from exports, but we saw a negative contribution from inventories, and that could bounce back, and you could continue to see this bipartisan budget act spending impacting the third quarter GDP. So it's not likely that it comes from the same sources, but we're still really stimulating the economy. We could get a number that's maybe not has a four handle, but that's higher than one might expect.
So we live in interesting times.
We do indeed.
Thank you very much. Great to see you.
See you too.
Yeah.